Hey everyone, welcome back to the channel. Today I want to talk about a company that I think might end up being a pretty good value play. If you're new around here, I wanted to quickly point out that you can follow along to any of my valuation videos. All you need to do is scroll down to the description and there will be a link for the model. You will need to make a copy of this model, but that will then grant you edit access so you can follow along and adjust my assumptions as needed. That company is Chegg. If you're unfamiliar with Chegg, they are a company that primarily sells answers to homework problems, writes essays for students, and sells used textbooks. If you look at their stock price, you'll see it's kind of all over the place over the last few years. It peaked around $113 per share back in early 2021. And then we saw after the pandemic a sharp drop off in their stock price from around $60 per share to around $30 per share in October of 2021. After that, they lowered guidance on the basis of students returning to campus and leveraging their services less. The stock has continued to drop since then, without any help from ChatGPT. A lot of speculation in early 2023 was that Chegg would largely go away, as you could leverage these large LLMs to write an essay or answer your homework questions. The stock has been hammered, dropping all the way down to just below $3 per share today. I've been a bit confused about the stock drop. In my mind, I think there's been an overreaction in regards to AI and Chegg. I don't believe LLMs will replace Chegg. As a student, I don't just want an answer, I want the answer. And that is largely what Chegg is providing for students. I believe there will continue to be this demand for their products over time, even if it is less than today. Yes, we've exited the pandemic as well, and everyone is back to being on campus, so I thought there must be a huge drop in their revenues. So taking a look at their 10Ks over the years, I was actually surprised to see their revenue trend was not what I expected. Going back to 2016, let's quickly recap the revenue. In 2016, revenue was $254 million. 2017, $255 million. 2018, $321. 2019, it grew to $410. 2020, we started to see a lot of growth from COVID and it landed at $644 million. In 2021, it shot all the way up to $776 million. 2022 came in roughly flat at 766, and then 23 slightly down at 716 million. So I wasn't seeing this large drop off that I was expecting. I assumed revenue would have cratered after COVID restrictions eased and the stock kept plummeting. But they've largely remained flat with kind of a modest decrease around 7%. Even looking at their Q1 results for this year, revenue is only down year over year by about 5%. So once again, not a huge drop off. They even became profitable for the first time in 2022. Their income statement shows them driving a profit of $266 million. There's some tax benefits and some other income from debt extinguishments that make it look a lot better than it is. If you back those out, you still have a profit of about $2 million. 2023, they also show a profit, but once again, it was largely driven by their other income from debt extinguishments. So without that, they lost actually about $100 million in 2023, so kind of going back and forth. So this brings me to my next point. They need to get their costs under control. Their gross margin is actually really impressive, just above 60% historically. However, they are spending an astronomical amount on both R&D and sales and marketing / general and administrative. Their operating expenses have historically outpaced their gross profits, which is worrisome, especially at this juncture where we're no longer actually seeing the revenue growth, but rather a slow decline in revenue. One other thing to note is they did issue a decent amount of debt starting in 2019 through convertible notes. The first tranche they issued was roughly $700 million at 0.25% interest rate when the share price was around $40 per share. In August of 2020, they issued an additional $1 billion in notes at 0% when the share was priced around $80 per share. The good news is both tranches were near 0% interest rates, and the fact the stock has dropped significantly, people will not be converting, so there will be no dilution. The bad news is they do still have to pay back the debt. Of the $1.7 billion in debt, it all comes due in 2025 and 2026. They've actually aggressively started paying it off, and their current debt balance sits just around $600 million. So they've paid off a little over $1 billion. The bad news, they only have about $600 million of cash. So to pay off the remainder of the debt, they'd deplete all their cash reserves. The good news, once again, is that their business does provide about $250 million of cash per year from operations. So I believe they will be able to easily pay this debt off by the time it's actually due in 2025 and 2026, assuming the business does not see a sharp decline by then. So I pulled together a very quick model to see if there is a scenario where this company could be a great value play. So let's quickly jump into it. Starting with my assumptions, keep in mind this is pretty high level. I haven't done a ton of research or digging into Chegg at this point. I have revenues continuing on a slow decline at 5% annually for the next decade. COGS staying roughly flat to 2023. SG&A, excluding depreciation, will decrease 1% annually as a percentage of revenue, going from 33% to 23% of revenue. R&D will do the same as SG&A and decrease 1% annually, going from 27% to 17%. CapEx, I've held flat over the next decade to 2023 levels. With all of these assumptions that are pretty high level, we get them becoming EBIT positive in 2026. Revenue is going to drop from 716 million all the way down to 428 million in a decade. Free cash flows, though, go from a negative 28 million to a positive 57 million by 2033. So this model does entirely rely on the company realizing they're no longer in growth mode. They would need to start cutting costs, especially around SG&A and R&D. This really shouldn't be that hard. It's only 1% annually I've layered in. And they've been issuing over 130 million in stock comp each year for the past few years. So if you take that away, cut some staff, stop some of the R&D efforts, and you're going to have a profitable business that can flow a decent amount of cash because you have such a good gross margin. So with all these assumptions, we end up getting a valuation between 300 and 755 million. Unless there's something I've critically missed about the revenue declines, I think this could actually end up being a pretty good value play. With a valuation in that range, it would imply the stock is, fairly priced on the low end and, almost half underpriced on the high end. And I actually saw today an article come out that said Chegg actually just launched a restructuring plan. So it looks like maybe that focus on cost cutting is actually going to come to fruition. And if it's significantly more aggressive than what I've layered in, this could actually end up being a really good value play. I currently don't have a position in Chegg. I may look a bit more into management, listen to some earnings calls, and get a sense of the business and understand if there is anticipated to be a really quick decline in revenue that I'm not seeing, or if they have a large focus on cost cuts. I don't think their debt position is going to be the end of them either. I think this may be a longer term play. It may take a few years for the market to sort of notice them. If the price suppression really is related to ChatGPT, I think it'll take a year or two of nominal revenue decline or flat revenue for the market to start to price them fairly and understand that they're not going away due to AI. So once again, I think Chegg is an interesting play, but as I said, I need to do a fair bit more research before I would be comfortable making a position, but it does seem pretty appealing on the surface. So anyways, that's all I have for today. Thanks so much for watching, and leave a comment below.